Today, we're completely decoding the story behind India's absolute giant of an online B2B marketplace, IndiaMART InterMESH. Did you know this absolute behemoth is completely cash-rich and carries literally zero debt? Yeah, zero. Let's jump right into the data and see what's actually going on under the hood.
So, the biggest question on the market's mind right now is this. Does this heavyweight have what it takes to win the long race, especially with the recent market challenges we've seen? We're going to dig straight into the source reports to find out.
Here's our quick roadmap for this explainer. We'll be covering their business model and network, the latest financial performance, the big silver tier challenge, ARPU and margin trends, valuation fundamentals, and finally, the future outlook. Let's get to it.
Section 1. Business Model and Network.
First things first, IndiaMART is the undisputed heavyweight champion of online B2B marketplaces in India. The scale we're talking about here is just massive. They're connecting millions of SME buyers and suppliers across an incredibly diverse range of industries. We're not just talking about a simple directory here, it's an entire digital ecosystem for Indian small businesses.
So, what's their actual moat? How do they keep their edge? Well, they don't just list products. They offer a supplier's web storefronts, priority listings, lead generation via RFQs, and even pack in robust CRM tools and cloud telephony. It's this powerful two-way discovery model that really locks in their competitive advantage.
Moving on to Section 2, Latest Financial Performance.
Now, here is where things get really interesting, and honestly, a bit jarring. Look at this contrast. On one hand, you've got revenue growing steadily by about 13.9% to 404.3 crore rupees. That looks pretty good, right? But then, boom. Net profit takes a massive 72.2% nosedive down to just 50.2 crore rupees. This massive drop is exactly what has every analyst doing a double take right now.
So why the massive hit to profits? Well, collections are actually perfectly fine. In fact, they grew 10% year over year in Q4. The real culprit here is margin compression. They're heavily bumping up their marketing spend, investing back into the platform, and dealing with higher operational costs. Basically, they're sacrificing some profit today to fuel future growth.
Section 3. The Silver Tier Challenge.
Let's talk about subscriber churn, which is arguably the biggest operational hurdle they're facing today. Customers on the platform are split into tiers, and the silver tiers is really struggling. They're only getting about 7 to 10 residual leads a week, and as a result, they're churning at a high 5% rate. On the flip side, you have the gold and platinum tiers bringing in 20 to 100 high-intent leads a week, so naturally, their retention is super strong.
Visually, it looks like this. Exactly half of their customer base is sitting in that silver tier, but they only bring in 25% of the total revenue. Meanwhile, the other half, your gold and platinum subscribers, are doing the heavy lifting, pulling in a massive 75% of the revenue. It's a classic case of a small, highly engaged segment driving the bulk of the business.
So how is management actually tackling this churn? They're getting aggressive. They're now redirecting 80 to 85% of all inquiries straight to paying subscribers to make sure they get value. They're also actively working to reduce supplier competition per lead. And get this, analysts estimate that if IndiaMART can reduce churn by just 1%, it could trigger a massive 5% jump in overall net subscriber growth.
Section 4. ARPU and margin trends.
Let's talk about how they're actually making their money right now. Average revenue per user, or ARPU, is growing at a really solid 8 to 9%. But if you look at new customer growth, it's crawling at barely 1 to 2%. What this tells us is crystal clear. IndiaMART's current growth engine is entirely fueled by upselling to their existing customer base, not by bringing in waves of new users.
And management is completely transparent about this. CEO Dinesh Agarwal himself explicitly stated, since customer growth is hardly 1 to 2%, most growth is coming from ARPU. They are openly acknowledging this massive strategic pivot from volume-led growth to ARPU-led growth.
Now check out this number, 32.8%. That's their Q4 EBITDA margin. Yes, it's dipped from 36.7% last year, we know that. But let's put things in perspective. For an e-commerce or B2B platform, maintaining an operating margin north of 32% is absolutely rock solid.
Section 5. Valuation and Fundamentals.
And here is the magic number. 0. As in zero total debt. In an era where so many tech platforms are absolutely buried under leverage, having no debt whatsoever gives IndiaMART an immense financial safety net, no matter what kind of economic headwinds hit the market.
Here's another jaw-dropping figure for you. 1,965 crore rupees. That's their deferred revenue, which is up 17% year over year. Think of deferred revenue as money customers have already handed over in advance for services. Sitting on nearly 2,000 crores of advance cash gives them incredible visibility and security for their future earnings.
Numbers like this clearly show that this business is literally a cash machine. They are sitting on a cash and investment pile of 3,280 crore rupees. Just in Q4 alone, they generated 290 crores in operating cash flow. It's exactly this massive cash reserve that allowed management to propose a super generous total dividend of 60 rupees per share for FY26.
Finally, Section 6, Future Outlook.
So what are the market experts saying? Both HDFC Securities and Motilal Oswal are maintaining a buy rating on the stock, with targets of 2,800 rupees and 3,050 rupees respectively. They're pointing to the improved growth visibility and the extremely limited downside risk thanks to that massive cash pile we just talked about. As for management's own guidance, they are targeting 10 to 12% revenue growth for FY27 while keeping those margins steady around 33%. But CEO Dinesh Agarwal has an even bigger vision. He wants to double the company's revenue by 2027. To actually pull that off, though, they'd realistically need to hit an annual growth rate of 22 to 25% moving forward, which is definitely ambitious.
That brings our explainer to a close, but I want to leave you with a massive question to think about. In a deeply price-sensitive and vast market like Indian SMEs, is pivoting to squeeze more money out of existing customers, focusing on ARPU instead of aggressive subscriber volume, really the right long-term strategy? Keep a close eye on how this strategic shift plays out. Thanks for joining me on this deep dive, and we'll catch you in the next explainer.